everyone, and welcome to another episode of the Vantage, the Street's flagship podcast, where we bring conversations with leaders across finance, investing, entrepreneurship, and beyond. I'm Siddharth Mittal, Research Director at D Street.
And I'm Aditya Kumar Yadav, Corporate Communications Director at D Street. Today, we are extremely excited to welcome Mr. Shridhar S, who brings more than 25 years of experience across private equity, investing, and corporate leadership. He is an I am Ahmedabad alumnus who has held leadership roles and is currently working across multiple asset classes. He is also a wanderlust who has explored 125 plus countries across all 7 continents. Beyond investing, he's also deeply involved in teaching, mentoring entrepreneurs, and working in the social impact ecosystem.
So it's a privilege to have you with us on Vantage. Welcome.
Thanks. Good morning, and an honor to be here. Thanks for having me, Siddharth and Aditya.
So you have spent more than 2.5 decades in private equity and investing, having led majority stake investments aggregating over $750 million. So looking back at this journey, how has your private equity mindset towards investing evolved over these 2.5 decades?
So let me just go back to where I started from. So I entered IIM Ahmedabad at the age of 19 and I graduated at 21, which is a fairly raw age to graduate. And I joined, which then was a venture debt fund at that point of time. And it had a fairly large assets to be deployed. And at that point of time, I had a reverse pyramid for their organization structure. The junior most used to decide the most, and then the entire hierarchy would be following. And there was a guy called Vagul who actually had recruited MBAs from the IIMs at that point of time. And most of the leaders from the financial sector, if you look at it, would have the earlier version of the bank or not. So when I was in 1990, I remember I did my summers with Hindustan Lever. And I was very clear I was doing Hindustan Lever summers because I knew I would never do sales or distribution. I wanted to be doing something else other than that. So I said, let jolly well get the experience. Hindustan Lever used to be a day one company there, even for summers. I got the summer internship, did the summers, did some very interesting stuff on due diligence. And when I finished that, they actually gave me a PPO, and I said no. And when I came back to campus, it was a real problem for me because it was very clear that I didn't want to do banking, I didn't want to do consulting, I didn't want to do marketing. And I come from a very humble family. So there was a very interesting challenge of what to do. And interestingly, I also met one of my batchmates who's the gold medalist, Vijay Agarwal. And I confessed to him that this is the problem. And very interestingly, you also said that, oh, mera bhi yahi problem hai, boss, kya karte hain? And he actually came up with the idea saying, let's do something very different. We will take money from rich people. We will deploy it with various entrepreneurs in various businesses, and we will build it up. And when we make money, we will give it back to the people that gave us the money, and we'll take a cut. And that's how both of us, Vijay and me, got into this business. 91, I joined. I was very clear I wanted to join there because that gives the investing experience. And Vijay joined investment banking. And both of us came together in 94 to do one of probably India's first family office kind of stuff. So in a lot of ways, we entered private equity even before the name was known to us. Okay, but most important, I think, in both of us figured out very clear is that we need to be very clear about who's the customer of our life. Okay, and I think both of us are fairly clear that the customer of our lives at that point of time were entrepreneurs. And we were investing capital and other things with the entrepreneur or the founders to make money for themselves and for ourselves. And that's how I got into this game in 94, 95. Very interestingly, very few people knew about the concept, and we had a very great lifestyle. So people wondered as to what we were doing, whether we were doing something illegal. But by I think 2000, venture capital came into India. And probably about 2005, 2007, private equity of the size that came into India. The industry has morphed quite a lot from what one started off. And I think I started off in 91 or 94. The amount of capital has increased, number of players have increased, a lot of global people have their presence here. The kind of sectors that people have invested has changed. So the industry is totally morphed in a very, very different way, and we can talk about the details at a later stage. But my fundamental discovery of both investing and private equity, which I didn't understand so clearly now, is that as an investor on either listed or the unlisted, you are actually an entrepreneur of entrepreneurs. you are not investing. You are actually understanding the entrepreneur and trying to invest in the markets. I also distinguish between investing and trading and gambling. People who do day trades or trade within 6 months, they're probably doing trading without much clue of the fundamentals. I am very biased by Warren Buffett, so I'm probably one of the guys who think about investing and fairly biased that investing comes from what I call as fundamentals, right? So the number of assets have increased, number of people have changed, a lot of people have made money. So lots of things have happened in the last 35 years. And to put the number to your audience, probably is double the age that they've seen life, right? So you can either consider me to be an old fossil who's preaching, or probably a young 18-year-old still trying to understand the world of AI and trying to invest.
Okay, so that was a really nice phrase, like being entrepreneurs of entrepreneurs and being having entrepreneurs as your customers. So, was there a particular investment early in your career that significantly shaped your approach towards evaluating businesses and your investment thesis?
Uh, so there were a couple of them which really shaped my investment thesis in a very different way. There was this company called, which was 92, and I was we were probably that was in, and they were actually making highway parenterals and a lot of pharmaceuticals and drugs, and they were struggling for capital and they had a founder called Habil Korakiwala. And I still remember as a 22-year-old dragging my manager. Think these guys can actually take money from us and they can make a lot of money for themselves. And then was probably our 150 crore company, and then they went up to today. They went up and down for various reasons, but they're a fairly large company at the moment. The second most big experience was when we acquired Exide Batteries and Johnson Tiles, and investments, set up a lot of greenfield investments. It really taught me a lot of things. What they teach you in B school is nothing. So you need to learn from people out there in the market. But two or three things that came to me very interestingly is doing businesses in India is tough. You need to figure out the way. And this is a free discovery of 94, which I still hold. But luckily, we have the Jugadu mentality, and you've got outside people who can do it. But it's not an easy game. I wish it was like a China or the US, where doing business was a really, really interesting game. Number two, I think it's all about people. And I think as a young when I was in IIM, underestimated the people. And especially when you're a young person, you need to really learn and command respect. And respect is always earned. The respect comes from listening to people and putting back solutions and getting a buy-in from them. I think the third thing that I've really got reinforced is the value of ethics and integrity. I think, and most people don't realize, and I realized quite early in life, that most people talk of brands in terms of companies. I talk of brands in terms of my own personal brand. I've been fairly anal or fairly cautious about what this brand stands for, and be as far as possible be authentic about it. Not a saint, but you just need to be extremely clear about what your brand values stand for. And those are three things that I've very interestingly picked up in the last 35 years. And last but not the least, again, most people think investors and the people who keep capital are the gods. The biggest discovery for me, and a lot of wise investors will tell you that, especially in the unlisted market, you are a slave of the founder. Once you put in the money, you have put in the check in the bank account. It is the founders and the management team who have to give you your exit and your carry, as you know, of this business. So you need to ensure that the power equation you know very, very clearly. That once the check has hit the bank, the founder has to be determined to give you back the return that you are looking for. So it's a kind of a partnership, but at the same time, you need to know your role as an investor in businesses.
That was a really interesting answer. So you have also had the opportunity to experience both sides of the table, like operating at the CXO level and also evaluating companies as an investor. So how did these operational roles shape the way you evaluate founders and management terms today?
A very interesting question. So I was very it's the reason I said you need to be very clear about the customer of your life and who's going to give you your money. I initially started with an hypothesis saying I'm entrepreneur of entrepreneurs. The grass is always greener on the other side. And sometime around 99, I said, why not be an entrepreneur myself? So as usual, you went on to the other side, and those days were the .com boom, like the AI boom. Like you didn't know what was happening, and everybody was talking Greek and Latin. So I said, now this is the time to become an entrepreneur. So I actually joined the kind of the what is now called the fintech space with one of my batchmates. And I did three interesting stints out there. One in fintech, then I went into what is now called GCC, but I was trying to do that in shares in registrars and services way back in 2002, and in 2004 I was trying to do something in life insurance. But the biggest discovery of those three instances is that it was a humbling discovery that I was not an entrepreneur. Okay, and that's a very interesting discovery. It took me about 2 years to digest the fact that I was not an entrepreneur, but I was an entrepreneur of entrepreneurs. So one has to be very clear that the life of an entrepreneur is very, very different. It's very, very hard. It's very, very harsh. And if you are a person who likes, like me, who likes to have one problem for every hour to solve, then you should not be an entrepreneur. Entrepreneur requires a lot of resilience, a lot of patience, a lot of passion for one problem. As an investor, I have a passion for multiple problems. So I can route my passions through various founders across sectors. So those 8 years actually taught me a lot about entrepreneurship. So in terms of how the founders look at investors, we were probably Warburg Pincus's first company to be invested in India, the first company that I joined. And it kind of taught me as to how we were 30 then, and a lot of the founders were also, I am the batchmates. We kind of realized what goes through a founder mindset when you hit a lot of money, when you have no money. How do you go and pitch? How do you go and busk, right? How do you ensure that you build a team? And how do you deal with people who are providing you with capital? And how do you put them, ensure that the role is boundary, at the same time they are respected and grow and also ensure that whatever you're doing as a founder, you have a selfish interest of doing it, but always keeping the organization first. And over the years, I've discovered if you do that, if you keep the organization first, your self-interest will also be taken care of. It is a very interesting game of doing that. The other thing I realized in that game is being an entrepreneur. I have a lot of sympathy, compassion in entrepreneurs for entrepreneurs today as an investor. It's a very tough one to be in the slot. So usually in all my investments, you will not find my name in any website, and that's very deliberate or anywhere. I'm always the person behind. Okay. And there's a clear rule with the founder saying that whatever we will disagree within the four walls. We will disagree, we'll fight with each other. But finally, even if I own 70-80% of the stake, you are the person on the seat. When you go out, I will support all your decisions. Okay. And that probably came up from the 7 or 8 years that I spent. One of my companies ran out of cash. And again, we are back to the wall for about 8 or 9 months and going and telling the employees that you can go. We don't have the money, and then the employees coming back the next day saying, we don't know. We are very passionate about this company. We are willing to take checks, salaries, cut checks. And one of our security guards actually coming back and telling me, I don't need my salary. You guys you take it up. Those are kind of moments which kind of help you as an investor, right? Most investors will not have understood what happens in a founder's head or founder's mindset, right? So I always believe every investor has to have that experience of having run a business and makes you a better investor at that. Okay. But I'm very clear I cannot be an entrepreneur. You have to be also very clear that certain things are beyond your capability.
Okay, so sir, you have looked at the entrepreneurial mindset very closely through your experiences. So now when you meet a founder for the first time, what are the signals that help you judge whether they can build a large organization or not?
So first of all, I think people there's this thing that everybody has to be large, right? There is this myth, everybody has to be unicorn. And I struggle to find that not everybody is going to be a unicorn. There is something called a desi style of business, which is the bootstrap business, or what I call as the indicorns, right? You don't need a large capital for most of the businesses, especially the service-oriented businesses. And for the founder, it may just make sense to scale up slowly and nicely with their own capital. When you get external capital, okay, I find it very strange that people don't understand it. If the moment you get external institutional capital, you're condemned to 3 outcomes as a founder. Either you go as an IPO, or say you get sold to a strategic, or you buy back. There are only 3 outcomes. In India, buybacks are not possible because of the taxation regime. So if you take money from any institutional investor, you have to do an IPO, which means you're permanent slavery. And you've seen that it's like 100-year slavery. And second is that if you sell to a strategic, you're selling off your baby. So you have to be very clear at the basic thing that why do you need institutional capital? And I always say that entrepreneurs should not only, if somebody's only do it for valuation, I always ask my founders, saying, other than capital, what do you need? And if the answer is nothing, I don't get into it. Okay, that's one thing very important. They should be very clear as to what kind of help you need, but then it resolves a lot of other issues that come up with the system. So coming back to the hygiene factors, one looks as ethics. Okay, very important, and ethics is very different to measure. But you go into the family, you meet the wife, you meet the people down there, and figure out how they view various ethics in life. Second, I guess, is past experience when they were not down, when they were down and out, and this is more in the PE world. Remember, the VC seed world is very different. By the time they reach PE, they have spent about 10 years, so their background is much more different. So the valuation can be a little more different. I'm speaking more of the startup space. Third, very important is resilience, and you always look for instances where they've really been resilient. Okay, and entrepreneurship is permanent. I call it permanent voluntary. Okay, permanent voluntary slavery, which you're having fun at. Because if you're doing good, you're going to have problems. If you're doing bad, you're going to have problems. It's a 24/7 exercise. Don't get to it if you're looking for what you guys call work-life balance and whatnot. Never going to happen, right? So the thing that you look for is that resilience. You look for ability. You look for capability, and when you're at a startup or whatnot stage, you also look at sole founder, co-founder is a very interesting thesis. Usually my finding has been that if you have more than 3 co-founders, you're dead. If you're 1, it's a very tough task, so it's impossible. 2 is okay. So 3 is the ideal number. If you've got 4, it's a problem. Always. We've been seen that for now 35 years. So you always look at either it's a sole founder, whether that person will get in a co-founder. And again, people misinterpret co-founders. It is not a designation. When you get somebody as a co-founder, they have a veto right on almost everything. Right? It's not like I'm making you because 10 years you're making a co-founder. A co-founder means you have a veto right. I will listen to you. There might be one leader who will decide, right? So on the co-founding team, you look at those things. Also, the other thing that you look at, I look at entrepreneurship as 3 things. One is you spot opportunities. Second, you gather resources, and third, you scale up processes, right? And there's only 3 elements to it. So as a founding team, you figure out where are the gaps that are there and where can I, as an investor, can bridge. And that's a very interesting way of looking at founding teams and founders, saying that what are the things that they would need to go to the next level. Okay, and see that if those gaps have to be built. A lot of investors run away after the gaps. I always believe investors have to look for gaps which can be filled. That's why you make money, right? And then help the founders to get the stuff. The fourth thing that you look at is the business itself, and there most investors don't do it. You really factor in your exit hypothesis up front. Okay, ultimately you know that you have to exit to an IPO or you have to exit to a strategic. Look at how many years you are going to invest in terms of time, 5, 7, 10 years, and figure out what's going to be the money there. If you're 20% of return, figure out what is the exit valuation, right? If you're making 100 million, and if people don't realize it, if you're investing 100 billion, and if you want 26% return per annum, in 10 years, you need to get $1 billion back. Okay, and then if you have to get $1 billion, then you figure out how this business is going to run so that somebody else is going to pay $1 billion for those cash flows, right? So you look at that business, see if it is scalable, and very clearly it is. The exit has to be planned. It's like in the West, people do prenuptials, right? Before marriage. And Indians find it a very interesting topic. कि शादी होने से पहले क्या prenup होता है? I always, most of the investment trick has been saying इसका exit कैसा होने वाला है बता लो, and you agree with the founder कैसा होने वाला है, right? If you think it's a strategic, the founder has to sell with you, right? So those conversations can be helping. But the fifth thing probably is that we look for failures. Okay, you have to have failed in life, okay, and you have to have come back, and that's where also resilience is measured. Last but not the least, it depends on the stage. When you do at the seed or VC stage, so there are 4 verticals in which you look at any enterprise. You look at the founder, you look at the problem that the founder is solving, the product, and the market. So you look at always at four verticals. Most people only talk of product market fit. Slowly, people have started doing a founder product market fit, but there's a 4 level of things: 4 founder, problem, product, and market. When at a seed or VC, at a seed stage or angel stage, you're only looking at the founder. There are multiple examples of founders pivoting, saying that if this is a founder that can find a problem, he will return my money, no problem at all. You are only banking the founder and a hypothesis. They're very, very interesting. Slack was actually a gaming platform. The guy had about $100 million, and about 100 million, he called up the investors and said that, boss, I can't return the money because the legal costs are much more. And they said, okay, I want to try something new. And this was during COVID, and Slack came out of it. And it turned out into $1 billion. I think the amount of you wanted to return was up to $6 billion. So you back the founder. But as you go into private equity, what happens is the founder is very mature. Your product is there. The markets are mature. You're always looking at whether the founder has a passion for the problem. And that's something which you measure, saying, is this founder passionate about the problem, or are they looking for money or something else? There are investors who say that you should look for money. I'm a little different on that. I think people should appreciate the value of money. I'm not saying money is not good, but they should have a bigger passion for the problem. So if I tell the founder that I'm going to give you $500 million for your company, you can sell it to a strategic, he will say, I will still continue. But if it's $1 billion, then I'll say you should sell it off to the strategic. So that's the kind of extent that you look for. And passion for the problem is extremely, extremely important. And you see that in most people who have had the resilience to last, right? Everybody has that passion for a particular problem. The product and the market can morph. You can go global, you can go domestic, you can go to tier 2, tier 3. The product will morph because of technology or whatnot. But you have to have the clarity as to what problem you're trying to solve and for what set of customers. Okay. And that's overall, if you analyze great entrepreneurs, you'll find that same trend of people.
Okay, so sir, you talked about scaling the business. So when you evaluate a company entering a rapid scale-up phase, what are the key strategic interventions you typically focus on as an investor?
Very interesting, and this is, I think, where a lot of investors go wrong. They use models to evaluate. No, everything is easy. If you have to grow, if you have to make double your money in 3 years, people don't understand that your business has to grow at probably 30% per annum. Okay, compounded. Okay, and usually people hold it for 5-7 years, and you've got a very interesting number of compounding that you require, and compounding can kill you, right? So when you look at, and that's something which has been my bane. People rely too much on models to decide whether to invest in a company. And I come from a school saying that you have to understand the business before you invest, and the business has to be so profitable of the future that it should be so attractive that you should be agreeing to you invest, and you use everything else as models to find data against your decision to invest. So it's very little different. You don't look at this data saying that I will invest, whether I will invest or not. But you understand the business in a fairly large way, and you know that this business will make money in the future. And then you look at the models and everything for data against your investment thesis. And most people will tell you that most senior people will tell you that models are useless. Okay, unfortunately in class that's what is taught, right? Making models because that's comfort way. But I'm glad that ChatGPT has come. Your models are going to come in 30 seconds, right? And that raises a very important problem of what are you going to do as analysts? If you look at cloud, it's like amazing. Your jobs are gone, right? What people used to take 30 days to do is come in 15 seconds. So coming back, what I always do is to add on to the founder problem product market. One looks at again 3 verticals, which is the supply chain, the value chain, and the cash chain of the business. To actually understand the full business from customer to raw material to the last thing, saying what are the various things that need to happen in terms of supply of goods, in supply of cash or working capital, and in supply of which are the segments of the chain which are going to grab the maximum profit. And you have to realize that investors are always making a forecast. You're not looking at the current supply chain or value chain. You're looking at saying what is going to happen in 10-15 years from that. For that, you need 2 or 3 things. One, you need to have deep understanding of the customer. So every business that I've entered into, I will understand the customer in and out. Okay, what is happening, what is the insights, and not only the current customer, what is going to be the future customer? What are they going to think about what it is, and why are they going to pay money? Then you have to understand the supply chain, saying that who are the people that need to scale up. For example, if Zomato needs to scale up, you have to figure out how many workers are going to come, right? And then you have to figure out where that supply chain is coming and what is going to churn. So a lot of people make that mistake, not understanding that supply chain is a lot about people. It is a lot about capital. Okay, Indians don't scale too well, unfortunately. And I can go on to talk why China scales well and India scales. And there are various interesting phenomenon of Indian culture which makes it not to be scalable. So what you do to figure out whether business will go is understand customers. Spend time not with the founders, but with their suppliers, with the competitors, with the entire supply chain, and figure out if it has to become 10x, will all these people become 10x, right? Otherwise, it's not going to happen. And then you have to figure out whether this founder is capable enough to get the maximum out of the value chain and maintain the profitability that you require, and the founder is able to get capital required to do that. So it has nothing to do with the model. The model only tells you, okay, the top 3 or 5 assumptions that you make, it gives you the sensitivity. I can make an assumption saying that, okay, if price goes up by 20%, in my back of the mind, I can know if 10% increase hoga to kitna hota hai, right? I can quickly do a ratio. But you need to figure out, boss, what will happen if the Maharashtra market doesn't work? And this person what will happen if we go international? Okay. So there are lots of examples where people have not thought through this problem, and investors come more from a analytical model background. I always say investment is all about chemistry and biology. The physical part comes in the model, which is very easy, and I'm glad AI is taking away that bit. So a lot of investors would go only on judgment on what will happen in the future across these 3 to 4 levels, right? For founder, product, problem, market, and the supply chain, value chain, and the cash chain. So the 7 words that you really like, if you really get into it and understand businesses, you have fun with it. Okay. And remember, the investor is making a bet on what he or she thinks. And when I mean investor, is long-term investing. What is going to be the scenario 3, 5, 7, 10 years later. And that's the fun of investing.
That was definitely eye-opening. Shridhar, when we look back at your time when you were leading buyouts at investment in the 90s versus your later, how do you think has the landscape of institutional capital in emerging markets changed?
Very interesting question. And again, going back, cut this portion out, but this is like the current political stuff where you're going back to Nehru for everything, right? I think it's a long way off. 30 years is a long way off. But at that time, there was nothing called entrepreneurship. I still remember there was only something like doing business, okay? And anybody who did business was an outcast. So it was a very different kind of mindset, limited availability of capital, limited availability of information, lots of constraints in terms of government, and nobody knew how to scale up, right? Because there was a licensing regime which ensured that you couldn't scale up. Cut to today, there's so much capital that is flowing through. There's only surfeit of capital that's flowing through. There's so much information available. Ticket sizes have gone up. Albeit my initial pre-P deals were the private equity sector came only probably around 2009 into those kind of sizes of deals that we were doing. But it is the deal sizes like today. It is about $1 billion. People don't mark to even blink, right? In 2009, $25 million people used to ship bricks. $25-50 million. It's at that time was probably about 200 crores. Yeah, I know people would hands would shake while sanctioning. But today, $300-500 million deals of a particular fund in an investment is not a challenge, right? The scenario has changed so dramatically in this business over the last 30 years. And what else? Capital has changed, the kind of people that have changed, knowledge has changed, foreign people have come in, foreign partners have come in, right? What most people don't realize, even today, the private equity side invests about $60-70 billion. 95% of the money comes from outside. Okay. And so when people are celebrating all the exits that are happening in the IPO, you will realize why the Indian rupee is doing badly. So you're actually giving back money to people who have come from abroad, and a lot of money is going out there, out into the system. Not good or bad. I don't know what about it, but it's a very interesting way of looking at stuff, right? So things have changed so dramatically. It's like, and for you, message for you is that you're a generation. Look at how life was in 2000. Right before COVID, and look at life at 2020, and look at life at 2026. So much difference, right? So you have to pick up what are the things that remain, and what things are remain is people have to make money, customers will buy what they give value, and you have to figure out supply chain, value chain, and cash chain. And the ticket size is going up. These are all sometimes have double-edged swords. But the other thing is, I think this business has become very glamorous. Like I always joke, 94, nobody would understand what I am doing. Today, 2026, moment I say PE, every dog, every cat, every security guard wants to join the firm, right? I don't know whether it's good or bad. because people are joining in without realizing that it's a 15, 20-year-old year run into a marathon. It is not a short-term game, especially if you want to become a meaningful investor.
Right, so that was a really nice answer. So over the last decade, India has seen a massive rise in the startup ecosystem, like you talked, with more young founders building companies right out of college. So from your experience working with entrepreneurs, what are some of the biggest mistakes early stage startup founders tend to make?
So the first one is very clear, and it's a question that I ask all founders: why are you doing what you're doing? Okay, and most founders never be are able to answer the question at the first attempt. I send them back and say, 10 years from now, if Siddharth is an entrepreneur, what will be the 3 measures of success with metrics? Okay, very important question. And everybody will think about, hey, I want 500 crores, I want 1,000 crores. Somebody will say $1 billion without knowing number of zeros. The immediate pushback I will say is, if 10 years you have 500 crores, what are you going to do with that money? Okay, and most people don't have an answer. You have to be very clear, why are you doing what you're doing? Okay, and the money is very important. My fundamental pushback is, if you want to just have 10 crores of wealth, okay, or 100 crores of wealth, if you're choosing 1,000 crore kind of a number, you will take all the wrong decisions and you'll make the wrong sacrifices, and after 10 years you will regret it, right? And there are various businesses which can make much more money than any of these unicorns, and have a little more peace of mind and be satisfied, not having useless investors on your table, but having satisfaction that you're solving a problem. If you look at the earlier generation, you come from tier 2 cities, right? There's so many business. The grocer there is happy, making a lot of money. Your tailor is there. A lot of businessmen, even in your towns, which are making good more money, and they're all entrepreneurs, right? They're all running their own businesses. So the first thing is, you have to figure out why you're doing what you're doing, and usually the second answer comes is because you're doing something because you want to do something for society. This means you're creating employment for a particular segment, or you're trying to solve a problem of a particular customer segment. That answer to why you're doing what you're doing needs to be upfront. And it can change every year. It can change as you go along. Every year you can change it, but you have to have a hypothesis thinking through what it is. The second thing is that people get glamorous, and I always believe that every person has a DNA, whether it's a B2B DNA or a B2C DNA or a B2B2C DNA or B2G DNA, right? People don't look inside and say, they just run glamorously after problems. And I've had people who have gone into a B2B business and saying, boss, tumko personality B2C ka hai. When you ask them as to why this business failed, they will say, I didn't understand how to sell to businesses, right? So that's the second level that you need to do. The third important discovery that I have had in life, only about 3 to 5% of people can be entrepreneurs. Only 3 to 5% of people. Not everybody is supposed to be an entrepreneur, then we'll have been disaster as a human race. And only about another 3 to 5% can be entrepreneur of entrepreneurs, which you call investments. And that requires a particular mindset. And over the last 25 years, I've become a big fan of psychometric assessments. The psychometric assessments which will tell you what are the gaps that are there in you, which will not help you make an entrepreneur. Okay. And that's extremely important to have it at a young age, so that you can at least build the gaps, right? And you'll know how much time it is going to fill the gaps. Not that you can't fill all the gaps, but if it's going to take 10 years, it is going to be a tough one. For example, I always use the cricketing analogy, right? And I've always been the Rahul Dravid fan. Rahul Dravid can never play like a Virat Kohli. Virat Kohli can never play like a Pant, right? Yeah, but they can be coached. They can acquire the muscles. Say particular cricket matches, they can play the other way around. When they come back, they will be their natural self again. So you can change your muscles as an entrepreneur, but you need to know what muscles to change. You can't just dive in saying I am a founder and doing that. The last thing I've seen founders make a mistake is they underestimate the power of capital. Okay, so you start a business when you're 21, you get into a capital-intensive business, saying that you will raise the capital. It's never going to come. And even if you get the capital and solve the problem, at the end of the day, you'll end up with 5% company stake. So you'll be a slave of all your investors because you don't have the capital. You're genuinely raising capital for solving a problem. So I always say that, boss, capital is one of the biggest SWOT analysis. Then choose businesses which are capital light. Okay. And choose businesses which you can survive for 2-3 years by raising money. And be very clear with your life partners including your family. Most people don't know entrepreneurs, the investors, the biggest investors are the family. Talk to them that this is a 10-year race that I'm going to run. I will not have money. I don't have time for you. And my sense is Shark Tank and whatnot has done a good job of glamorizing entrepreneurs. It is not. I've seen many people of 27, 28 figuring out, yeah, entrepreneurship is not my game, which you would have known upfront, right? So you have to be very clear. It's a long haul, long game. And very funnily, people from tier 2, tier 3 have more resilience. Right? You come from a thing like, boss, kidhar bhi so jayega, kidhar bhi busking karega, no problem at all. And your need for money is very less. So if you choose some interesting businesses which don't require too much capital, there's a higher bag for success as long as you know which muscles to build as an entrepreneur. Even there's an interesting one. And I strongly believe as it goes along, you'll find a lot of entrepreneurs and mini entrepreneurs coming from tier 2, tier 3, tier 4. So muscle ban raha hai. Tier 1 is all become lazy souls. They can't live in the heat. They can't. And especially kids of privileged people. It's very funny how it happens. I teach at Ashoka, so I know what. Even in Ashoka, people from financial scholarships, I find them so aggressive, so much hunger in getting what they've done. It will probably be better entrepreneurs. Unless you're desperate, you can't be an entrepreneur. Okay. So if you come from a rich background and if you think, "Arey, Papa hai, paisa de denge," absolutely not going to happen. To create your own levels of desperation. But at the same time, I would encourage entrepreneurship. It's a very fun game. It is a nice, challenging circus that you run. And it's very satisfying. At the end of the day, you have so many employees, so many people who are blessing you in a very different way. And that's the only reason you would do either entrepreneurship or investing. Money is good, but ultimately it comes from the joy of having changed the sector, a joy of employees, a joy of people coming and telling you, "I'm grateful to you." And probably you need to factor that and chase that into why you are setting up your own investment thesis in an entrepreneur.
Totally agree, Shridhar, to what you said. Now, we have been noticing that founders today seem to prioritize growth and valuations, sometimes even at the expense of profitability. And from a long-term investor's perspective, how should founders balance growth with financial discipline in their early stages?
I have a very simple solution to this, right? When you take something called alignment of interest, which is a very powerful 3-letter word, the founder's duty is to ensure that they are aligned. They find investors who are aligned to their wanting on the business, right? Where does the growth profitability crisis come? When you have different exit timelines, right? An investor wants to exit in 3 years. Founder says, "I want to continue forever." So what all founders need to do is have a honest conversation up front, saying that, okay, what are the situations, when do you want to exit? And what is the return that you want? I have not seen a single founder ask me saying, what is the return that you want? Okay. If they tell you 30%, you can factor it in and say, boss, मेरे को नहीं चाहिए ये वाला पैसा, ये तो मार डालेगा मेरे को multiple करने में. Ultimately, founder has to give back the money, right? So you have to have that honest conversation with the investor. From which fund are you giving? How many years do you have? What is the return? And you have to have that trust, saying that this is okay. Even if you say 20%, I'll at least try to give you the 20% return. But if it's 30%, tell me upfront so that I don't take your money, because you're going to chase me down, hunt me down, right? So I always believe growth profitability comes because of misalignment of interest. Suddenly you will find, and ask them, if the investor says 7 years, ask them what will happen in 10 years. Then you will not have this story, natak of trying to go to an IPO just because you have to find an exit so that you can raise a next fund. A lot of businesses get killed because of that. Right? The cosmetics industry is a phenomenal example. And they all said scale is because of excellence. Dal diya paisa to jana chahiye, right? The entire field of cosmetics is a story in that. Even pepper fry. So you have to have patience. And as a founder, you don't take the money. You're the one who's in control unless they agree to your times of exit. But as a founder, you have to be very, very committed to saying, once you've agreed to something, after 10 years, if something happens, I will sell to a strategic at a particular level. But you have to have an upfront discussion as to why is the investor investing in the business. Number 2 happens is, and I've found a lot of founders will say, unless you understand my business, please don't come into it. Ulta. For valuation, don't come into my business. I know a lot of founders who are unicorn who will keep themselves below the unicorn status because they just want choice of founders. And third thing is, when you take money at a higher valuation, founders don't realize they're committing suicide upfront. Simple analysis, no? If the same amount of stake, if I take at 200 million and I actually get it at 400 million, if somebody is wanting 26% return per annum, if you have to give back 800 million, if I take it 200, you have to give back 400 million, right? Right? And if I taken that at a 200 million valuation, probably that person will wait for 7-10 years. And the compounding effect, I as a founder will make more money because I will have a smaller pie of a larger cake. But these things are, as I think Munger puts it, these things are very commonsensical but very uncommonsensical, right? And for me, always investments has always been a lot about psychology of human beings. Okay, I always find you need to understand. I have a 4-letter word called "what is in it for me," which is you have to understand what the other person is looking for and start bringing alignment of interest. Once you get that in, I don't think there is an issue. Because investors know that if you can't, because if the outside conditions are bad, then nobody to blame, right? But unfortunately, a lot of founders land into this problem because of internal problems, because they're greedy or they don't understand investors, or sometimes they're desperate for capital, right? A lot of other reasons that happen. Have I answered your question?
Yes, sir, for sure. So you must have heard a lot of founder pitches. From founder's perspective, what are the most common mistakes entrepreneurs make while pitching to investors?
At which stage?
At an early stage, like.
So let me just caveat. I have not. So I invest time capital with the early stage. I've always been a private equity guy since '94, but I do a lot of time capital investment with early stage, and I also mentor a lot of people. I think the biggest mistake founders don't do is saying. I think biggest thing that founders do is say, "I know everything." Okay. So when you are at the seed stage, what are you doing when you're going up and down? You're actually like an onion peeling of risks, right? So when you are at the seed stage or at the VC stage also, there are so many ifs. But most founders come as if all the ifs are not there and I've solved all of them. It might be better pitch saying that this is things that I've covered in terms of the customer, in terms of the value chain, in terms of the supply chain. Okay. And these are the things that I'm going to do with your money for the next stage. It's almost like a laboratory saying that I am solving a problem, I have found this solution. With your money, I will take, but there are lots of uncertainties. And I don't see I like founders who say, I don't know. And then come back saying, I have an hypothesis. Let's find data for it. Data against it. Okay. One of the key elements of an entrepreneur I've always found is they form an intuitive decision and they will hunt for data against it. Most human beings only form a decision and then they'll only look for data for it, right? And then they'll get confused. Ki kya karna hai, nahi karna hai. The moment you get into a situation, you become very clairvoyant. Because there are only two answers, right? If you really have a decision to make, it's yes or no, and no means not for the current future. Khatam ho gaya, it's always you can always do it from a toss of a coin. So most entrepreneurs make that mistake of over promising, over delivery, running after valuations. At that stage, you only need investors who understand the business and will help you get to the next stage. Nothing else. Moment you run after valuation, it's a dead game. Because the investors are also doing the same. It's alignment of interest again. If they're willing to discuss valuation, so I tell at this stage, don't even discuss valuation. Chhod do.
Sure. So that was indeed insightful. You have been deeply involved in the social impact ecosystem as well, along with your corporate work, where you invest time capital instead of financial capital. So could you explain why this model of contributing strategic guidance instead of money is so important in the social impact space?
So first thing, there's nothing called social impact. Okay. People are just giving stuff. I believe that charity is the most selfish thing you can ever do. Okay. There is nothing selfless about charity because you will only do charity if something may not be monetary. It might be fame, I might feel good, I might feel something, but it's the most selfish thing that you can ever do. So there's nothing called social business. There's nothing called impact investing. Okay. Again, impact investing is just a spectrum. So, and a very funny bit is if people don't make money without the soul, which is what I call as other normal investing, there will be no money for philanthropy, right? Somebody has to make some sin to get some soul, right? So the way I look at this is that there's no difference between a not-for-profit and a for-profit. Okay, except for one or two. The first one is both require surpluses. One is called profit somewhere. One is it is both required to be deploying capital somewhere. Both have customers. The only difference in a not-for-profit is like a K-12 education system. Like your father, that's I was asking Siddharth, who pays for your father is paying for fees, is the customer. Same thing in not-for-profit. Aditya, who's from a poor soul, he'll come and say, as I'm a customer who wants the services in education or health. There's one donor who's sitting saying that, boss, I want to give my money to help Aditya. And that it's just like K-12. It's only that you got to have two sets of customers, right? The third difference is the challenges are the same. I thought I entered the impact sector about 5 years ago. I thought it would be very different, and I was very surprised that it's the same. How you evaluate, but the only other difference, other than the difference, is the taxation side. So when a donor gives, you get a taxation benefit. Okay, if there was no taxation benefit, there would be no difference between a for-profit and a not-for-profit. Number one. The only thing that differs between the two, and I always believe, is the soul. Probably in a social enterprise, you will have more soul than a purely shareholder based one. I kind of challenged my class saying even Marlboro is a social enterprise, right? Because it gives so much employment to agriculture. It gives so many CSR. Uber is a social enterprise, right? So it's I mean everything is a social enterprise. Ultimately, what determines it is the soul of the founder. Why are you doing? How compassionate are you in taking various decisions? Is what is very important to define what between social and not social, and between for-profit and not-for-profit. The reason I got into the space was very interesting. And then there's other discovery in life is when you're young, you run after wealth, and wealth is a good benchmark. After some time, you realize that wealth actually is a double-edged sword. If too much wealth, then people can't do what I do, and realize very fast. I've actually seen a live volcano at 5 feet distance. I've actually crash landed in the Serengeti. So even though when I was making wealth, it kind of came up saying that, boss, what would happen if I was a Bill Gates and I was stuck in the Serengeti and somebody would kidnap me and take me away, right? And slowly I realized that more than wealth, what one needs is blessings. And that's a very interesting change that I brought about, saying that I need to get blessings, and blessings comes from when people are grateful to you. And probably blessings are the only thing that can carry. If somebody blessed Siddharth and Siddharth is blessing me, probably it comes to me also, right? And second, the only thing that even if I die, it will go across. And very interestingly, connecting it back to SRCC, my blessings balance started when I was actually with one of the SRCC alumni, Ravi Gulati, who's founded an organization called Manzil. And he's probably the billionaire of my batch. Okay, who has got so many blessings. He's impacted so many people from lower income kids in the Khan market area. Just Google him. Amazing alumni. And very interestingly, he's given me the opportunity to behind the scenes help him create that organization. And very importantly, I think that that organization had a very interesting message for me. So I used to go there every year and just understand the customers. I've always been customer friendly. To understand Manzil ka customers kya bolte. So I used to have a session, and one of the most toughest question I got at the age of 36 at a Manzil meet was one guy said, "Bhaiya, what is your definition of success? You look very successful." And that put me on the spot, and I usually don't lie. And this was about 12 people there, and I said, "I don't know. I've not thought about this." I thought success was money, but what will I tell a driver's kid saying, I'm worth X amount of crores? He will not even know the number of zeros. And what do I tell him is the definition of success? But at the end of that entire session, I'm very happy with the definition of success that I had, is that I go to bed every day tired. I go to sleep in 30 seconds, absolutely contented that I gave the best to the world. And when I get up, I wake up in 30 seconds, so excited that I've got so much to give to the world. But I guess it's also the power of blessings from Manzil and other people. And now I kind of made it into a structured investment. Even when I teach, it is not for teaching. I don't go for teaching. It's actually in a class of 50. I try to find 5 or 10 change makers whom I invest time with. And those change makers will change the world. And I will get blessings from the people that they impact. So you need to have an investment thesis in almost everything in life. This is my message, right? And everything is a portfolio. You can't most of you guys are just doing one track career. You need to have a portfolio. You need to backpack. You need to do meditation. You need to do marathoning. Each one links back to either being a better investor or better human being.
So you talked about having a portfolio. Like beyond finance and mentoring, your personal journey has been equally fascinating. So you have backpacked across more than 120 countries across all seven continents. So how has this global exposure influenced your perspective on leadership and problem solving?
Two things, and I will bring back marathoning also into the game. Okay, marathoning is the easier one to answer. Before I started running my first marathon in 2004 or 5, I have run about 4 full marathons and 20 now about 18 half marathons. Now I run with blind people. I run with PWDs. I actually pace them in 10 kilometer races. For me, marathon was a very interesting. It made me a better businessman. So for the first full marathon I ran, I quickly realized. The power saying that you need to only figure out your goal, which is 42 kilometers. But every marathoner will only plan about 10 steps at a time. We will not even, you'll waste energy. If you notice, we'll have a cap, we'll have something on our earphones, but we will not even measure the distance. We will start, we'll run, and we will only look for every 5-6 kilometers. But all we will do is taking it 5 steps at a time. Okay, and it was a phenomenal training of a journey back into business. Those days we used to make 5-year plans. I said, all this is humbug. Let's put a 5-year goal saying itna banane ka. And every time I used to only go, next 3 months kya karna hai, or next 1 mahina kya karna hai. So it became kind of rolling into the 5-year plan, 1 year and 5-year plan, and then it could change. And that really changed my perspective of business. In full marathons, you hit the wall. And most people who do marathon should hit the wall at one side. Regretfully, I've only done it once. But when you hit the wall, you are absolutely dead. And at that time, I did it in the Bombay Marathon. Some stranger came and said, "You're hitting the wall." He sacrificed about 5 minutes of his timing to get me out of the wall. But every time I'm down in dumps in business, I remember I'd come out of that wall. Somebody came and helped me. So this time also in business, something will happen. And very amazing how something comes out of the way and comes there, helps you. So that's on the marathoning side. If I look at the backpacking side, I've always been a good investor. So initially, I've always backpacked either for economic reasons, social reasons, or not natural reasons. Initially, all my backpacking was for economic reasons. So I've been into, say, Brazil in 2005, China in 2002, Turkey 1998. These are all economies that you're talking about today. These were not known at that point of time. Vietnam in 2005, Iran in 2015. So what has helped me, two things, is everything is either behind or ahead of India. So you can forecast saying what is going to happen. Second thing is in today's world, right? Today's war. Nobody knows how Iran looks. Nobody knows how Lebanon and Beirut looks. I have been backpacking through all these countries. I've been to Israel, right? So it's such a phenomenal on a stock market perspective. I know what is going to happen. People think it will end. It's not going to end because you know the Persian. I think Aditya. So you know the Persian culture. You also have traveled the US, right? You know what China and the power of China. 2002 itself, I found that China was 50 years ahead of US. Okay, there's a infamous blog that I put in 2000. I usually publish on something called Backpack Through Life. So that has become a very interesting journey from an investor perspective. The other thing is that if you're an investor, you're judging people, right? When you're backpacking, I don't have anybody. I don't know the language. It is a very interesting sense of people that I get, of whom to trust and whom not to trust, right? You don't know the language, but you have to figure out what hotel, what food, whether the guy is going to pick me up and kill me or whatnot because of my backpack. So that kind of assets. The third, I think it also makes you kind. I've traveled now so many places. 90% of the world, 99% of the world wants to be peaceful. They don't care which religion you are, which language. All they are worried about is having fun and making the next generation better. 99% of the world. Okay, so that gives you that faith, saying that there's some humanity. Now, of course, the headlines tend to distress you sometimes. The other aspects that I really want to talk about is meditation. I've done a 31st year of meditation, and what it has helped me is investing is all about patterning, right? You're forecasting the future, but it's all about intuitions. And probably meditation has helped me two things in patterning human behavior and in patterning what will happen. So it's a very interesting way of figuring out what patterns are there in various data, and meditation really helps you there. I've learned Latin American dancing now. I'm a trained Latin American dancing. It interestingly taught you the power of center of gravity. As an investor, you need to take various centers of gravity. Sometimes you have to act angry. Sometimes you have to act very interestingly. When I did Latin American dancing, I started climbing rock climbs without harness. So in Ethiopia, I've actually climbed 1 kilometer with the harness to reach a church and come back. And I said, why the hell is this happening? Then I realized it was Latin American dancing because I was changing my center of gravity to be able to climb it without a rope. Okay. And that's how I became comfortable. I was not very comfortable with heights. I'm now learning the violin, which was after now sixth year of learning the violin online. It has helped me. While in a very interesting topic again because of patterns, does the frets you're using all muscles of your body. It actually made me a more patient speaker and a patient investor because you're feeling almost every day at the violin, right? So then you don't think you're God's gift to myself. If you think you're God's gift to myself, at the end of the day, you come back to the violin, puss, सब हवा निकल जाता है उसमें कि you start feeling at that. So it's all about building a portfolio, whether it's you're an investor or an entrepreneur. It's all about building the portfolio. And the unfortunate bit for your generation is irrespective of whether you're a good investor or whether you're a good entrepreneur or a good salesman, you have to be all the three. Unfortunate. You have to decide how to invest your time. No company is going to give you any money unless you have an opinion, and you have to be entrepreneurial even on the job, and you have to be selling yourself to ideas. Otherwise, there's chat GPT. So you have to figure out how to sell your opinions and how it is going to be different from AI, right? So in a lot of ways, your generation is going to have the best of this. Your generation are going to have a good time. A lot of people will struggle, but they will also I think they will take some time to develop the muscle to be entrepreneurial, investment oriented, as well as better salesman.
So it was really interesting when you talked about diverse travel experiences and how they complemented each other. Was there any particular travel experience that fundamentally changed your worldview?
Many of them, I think two, and I will talk one in the economic sense and one in the climate sense. Economic sense, I think I went to China in 2002 and came back absolutely floated. Ever since then, every year before COVID, I used to go back because I invested to China, and that place is probably about 50 years ahead of us. And there's so many myths about that country. Of course, there's lots of things wrong also, but every country has its wrong. The second thing is when I went to Iran or Cuba, people talk of sanctions, but at the same time, you realize how economies survive even in the world of sanctions, right? And third, I think was when I went into Northern Ireland or Yugoslavia or a lot of the strife-ridden countries, right? And there it was very interesting seeing how, or Lebanon for that matter, how societies somehow get divided when politicians, priests, and businessmen come together. It's always the case when all the three come together at some point of time, then society gets destroyed. And it's very interesting around the world that this is what is happening now, right? Across the world. And people like, if Yugoslavia had not split, they would be probably competing with China. So it's a very interesting takeaway from me from an economic perspective. I'd also talk of Brazil when I went to 2005 because it was the first non-English speaking country that I landed without expecting it to be non-English country. But Brazil again is about 1/3 the size. It was then about 200 million. At that time, it was 1/4 the size, the population of India. But you could see a lot of similarities as well as differences with India. What most people don't realize in economic sense is India is a very small country in terms of land. China is probably 3 or 4 times the size, they're 5 times the economic size. So I think a lot of Indians need to figure out that, saying that, okay, there is a problem that we need to solve, confront it. In terms of natural thing, I think when I went to Antarctica, is that when I realized how all the dots of the world are connected. And I really became a much more environmentally conscious person after I came back. Because most people don't realize with climate change, most species in the world, they breed based on temperature, humidity, and length of the day. Okay, and so for example, the predator and the predator and the prey, their breeding cycles are synchronized, right? So if the prey has babies, then it becomes easier for the predator to actually eat more, right? And you realize that when you get warming, right, when temperatures change, the cycle tends to go. So when I went there were a lot more penguins than seals. So it's the entire balance of nature is going, and then it put into place how sometimes you wonder why trees are blossoming before, right? You've seen that in your suddenly trees blossom or something, some natural things so amazingly balanced in terms of temperature, humidity, and length of the day. It really made me a little more spiritual, and also be very conscious in a very, very different way.
Your experiences were genuinely very interesting to
The second one, just to ensure, was meeting a gorilla. Meeting a gorilla for an hour, that is ultimate. So if you have been divinely blessed to go to Rwanda and spending an hour with a gorilla family, You realize how similar they are and how loving and compassionate they are compared to human beings. It's an amazing one. And there's a video on that on my site on a silverback gorilla. Yeah, back to you.
So were you like in direct contact with those gorillas? Did you like very close to them?
See the video. I've been slapped by a silverback.
All right, I'll definitely check that out. So before we wrap up, I'd like to ask one final question on behalf of the finance enthusiasts here at SRCC. So for students who aspire to build a career in private equity, venture capital, or investing, what is the most important thing they should start doing today to prepare themselves?
So, okay, I'm glad you came to this question. Most people think about careers in finance. In my head, there's no career in finance. Okay, what you have to look at it at a very macro view is that you have people who are check writers, who are providers of capital, right? And then you have check users who are probably the entrepreneurs and the founders and the companies. And in between, there are the brokers or dalals, which is the investment banking side, right? There's nothing called finance. Most people talking about finance is accounting. Accounting is for historians. We are now in the business of capital deployment, and you need to figure out as students as to which part of the value chain you want to fit in. Whether you want to be the dalal who makes 5% of the interest of the transaction value, or you want to do a check writer, and then they'll figure out what is your risk return appetite and in terms of mindset. Do you want to work in a mutual fund? Do you want to work in a family office? Do you want to work in a private equity fund? Or do you want to work in a bank which gives debt? Right? There's lots of career options available across spectrum of equity and debt in terms of timelines in the check writer space. On the check user phase, again, you can segregate by sectors, by stage, right? So one has to look at this entire careers for you and these three buckets. And each of the buckets has sub buckets and figure out where you fit in. If I were to look at what you should be doing, I think a lot of you are glamorized with the private equity space. I would strongly recommend you will be very unlucky if you get into the space upfront because you're not going to have fun in life. Okay, what you should look for is figuring out where you will have where you will have the maximum learning in this entire space. And I always believe that there's three things that you need to have. Okay, so one is the ability to think. And a lot of you have become fairly reluctant to form opinions or form opinions too fast, right? That ability to think and form an opinion is extremely, extremely important. That's what judgment is, right? And unfortunately, because of AI, your generation is not going to have the ability that my generation had to make mistakes and learn from it. Right? You're not going to have models. You're not going to have a lot of stuff which we learned how to make mistakes, right? So that's the first thing I would learn. The second thing I would learn is the ability to pivot and look at everything from a skill set muscle point of view. I promise you, all of you are going to change careers in the next 5 years. You'll probably lose jobs, and you should all lose jobs earlier in the career than later. But all of you are going to change careers because the world is changing. Look at 5 years now, how much has changed? You and I are talking, which you could never have done it 5 years back before COVID. So I think your generation has to be extremely pliable, valuable, at the same time knowing what they are at the core. What value add they are doing and who is the customer of their life and what problems they're solving for them. Okay. So I would relate it back to the macro picture saying that what is the problem that I want to solve? If it is investment banking, then my customers are both the check writers and the check users. And my job is to put them together. That's the problem that I'm solving. If I'm a check writer, my problem I'm solving is for somebody I'm writing capital for the particular return. If I'm a check user, usually what I'm doing is using the capital efficiently to deliver returns to my investors, right? So you need to figure out at a higher level as to what problem you are solving, and rather than saying finance and whatnot, or jumping for glamorous roles, the entire industry is getting disrupted very badly. So your archetypes, role models are just not going to be there. You probably are going to create the new ones. And I've seen it multiple times. So that's why I'm so a little more confident of happening. I've seen 2009. Most people have not seen downsides, right? Most people have not seen things crashing. It's going to crash. I don't know what's happened to the market today, but very interesting. People like me have seen 7 crashes, so that's why I'm sitting on a call with you rather than be worried about what the market is doing. But I think I know what it must have done. A lot of people must have interesting feelings. But finance is a long-term game, especially in the check writing side.
That was a really good answer, sir. Mr. Shridhar S, this has been an incredibly insightful and candid conversation from private equity and investing to life strategy and social impact. This has truly been a masterclass for our listeners. You really mentioned nuances from your experience that really nobody talks about. Thank you so much for joining us today on Vantage. And to everyone listening, thank you for tuning in. We'll see you in the next episode.
Thanks a lot, and just a wish to all the SRCC people: go and build the country. Don't be afraid of failures, and just adventure in life.